Oh man, so Coinbase have just upsized their bond offering from $1.5 billion to $2 billion in what is seen as a really big endorsement for crypto. Let me explain. So Coinbase have looked to enter the bond market. And now the way you enter the bond market is you get a credit rating. So the agency Moody's, who's the biggest one, pretty much Moody's and Fitch. So Moody's have come in and they review Coinbase to see what their investment grade is. How safe is it to invest in Coinbase? And they came up with junk bond status. So this is the worst pretty much rating you can get in terms of categories. They're saying it's not investment grade. Okay, so what this means is, and they cited the reasons for this. They said the financials are good. The financial profiles of Coinbase are good, but there is too much uncertainty around regulation and there's too much fierce competition to give this an investment grade rating. Now, nonetheless, despite this being a junk bond, we saw 7 billion in demand for this offering, which meant Coinbase could up their offering from 1.5 billion to 2 billion. Now, why is this such a big endorsement for crypto? Well, normally, this is seen as super high risk, but now the fact that you've seen such a piling in from institutions is a great sign. Now, you can see here through this offering, hedge funds and pension funds, which are normally, very risk off and they're very hesitant in their risk, have piled in to get some access to Coinbase and therefore some exposure to the wider crypto market, which is fascinating for crypto. I mean, normally your pension funds and your hedge funds are not getting access to Bitcoin directly. Now, the only other bond offering we saw in the crypto space was MicroStrategy, who in June, they did an offering for $500 million and they wanted to buy Bitcoin directly with that money. So people knew what they were doing. It was a bet on Bitcoin. Now, in this case, Coinbase is saying they want it for normal corporate spending. Okay, so they want to do it to improve their product. They want to use that money to maybe do some mergers and acquisitions of any companies they feel are appropriate. And that's what investors have lent their money for. Now, they offered 7-year and 10-year bonds with rates of 3.375 and 3.625. Now, what does that mean? Well, the average company of that credit profile in a junk bond is paying about 2.86% per annum for the money. So Coinbase had to pay on the higher side, but they were still oversubscribed. Okay, so this is still a good sign for Coinbase. In a week where they had a lot of scrutiny, they were served the Wells notice from the SEC. This is a good sign that they were able to easily not only fill their requested 1.5 billion, but they were able to upsize that to 2 billion in an offering, despite the junk bond rating from Moody. Now, interestingly, Moody have given 3 key areas which they would like to see in order to be able to revise their investment grade up. And I think I agree with all of these 3 completely. So the first one is increased regulatory clarity. Now, this is not obviously something completely in Coinbase's control. We heard Brian Armstrong saying, look, we're doing our best to facilitate any requests. And ultimately, all these companies are complaining to the SEC of the same thing, which, there's no smoke without fire. If Coinbase are complaining about the same thing, Robinhood are saying the same thing, companies like Tether and Circle are saying the same thing. They just want guidance from SEC. XRP have been saying the same thing. What is a security? What is not a security? How can we understand? What are we allowed to do? What is the framework? Coinbase wanted to release their lend feature, and that's why they got served the Wells notice. Why? Why are we allowed to? What did we do wrong? What can we do? What can we not do? That's what they're saying we want. And Moody's agrees. They need increased regulatory clarity. The second thing they want to see is a big expansion of its product offering and services, right? We spoke about this when we analyzed Coinbase's earnings. We know that we need to be able to diversify. We've spoken about this on Robinhood. They've not been able to diversify from payment for order flow, right? So if Gary Gensler comes in tomorrow and bans payment for order flow, Robinhood's in trouble, 80% of their revenue. Now, we don't want to see that same thing for Coinbase. They need to be able to diversify away from all the transaction volume risk, because in a bull market, remember, Coinbase are making their money as a percentage of the notional trading volume. So if trading volumes go down in a bear market, Coinbase's revenues will suffer. So what Moody's are saying is we want to be able to see a broader scope of products. And I think Coinbase already know this. We've seen that in their earnings report. They've started a few different services, their staking, their lending, which they wanted to introduce. And I think the SEC have just stood in their way there, but it's clearly on Coinbase's agenda to diversify their revenue, get more into DeFi, into the lending, into the staking, and become, the crypto equivalent of the institutional banks that we've been used to. And the final thing that Moody said is they want to see more prudent cost management during the low periods in the crypto markets. And I think this is a good point. So not only do they need to find a way to diversify their income during the bear markets, but when these inevitable bear markets come in crypto, Coinbase need to show that they can easily flip their operating model to reduced operating expenses so they remain profitable even in those periods, and then come out to play again in the bull markets that we see. Now, the other interesting thing is, the argument is happening in crypto is, are we going to decouple away from this bear bull markets, these cycles we normally see? And I think some people are saying, no, you will not leave, these bull and bear markets are going to continue because of the halving events. Others are saying, no, as crypto gets bigger and bigger and more institutional money and countries adopt crypto, it's going to just have a continuous super cycle where it just trends in one direction. I mean, that's yet to be seen. We'll have to see how that plays out. But either way, a really good sign for the crypto market in a whole that, that Coinbase, despite all the regulatory scrutiny, were able to come out with a junk bond and were oversubscribed by 5x on their offering. It's a great sign. Now, what could this mean for the broader market? Could this mean, obviously Coinbase can do more offerings because at 3%, they'll be more than happy to have that cash on their balance sheet and pay 3% on that, because it allows them to move quickly in a climate like Moody's have said, which is fast growing and very fierce competition. They need to have the cash on hand to be able to fend off the likes of Binance. If Binance US are looking to go public over the next couple of years, you've got Gemini, you've got BlockFi. But now, maybe those companies will be looking to do the same thing. Maybe Binance, maybe Gemini, maybe BlockFi will come out and do an offering of the same. This will give more exposure for institutions, for pensions, to hedge funds into the crypto market, which net is positive for the crypto climate. So there you go, guys, an update on Coinbase and their public offering. Normally, public offerings don't give you much news or any excitement, but I think given that this was the first major one in the crypto space outside of MicroStrategy, who are just obviously directly buying Bitcoin, this is a true feather in the cap and a big endorsement for crypto. Thanks for watching, guys. If you like this type of video, please don't forget to hit the like button and subscribe, and I'll see you in the next one.